I'm here today with Chris Harding. He is one of my favorite lenders. I've learned this over the past 2 years. I was sitting here on this couch pregnant 2 years ago, and since then we've probably done 15 deals together. He's fantastic. He pulls bunnies out of a hat, so if you're looking for creativity, this is your guy. But today we want to focus on construction loans and how he can get me from point A to point B with our build project that we're pursuing.
That you're working on.
Yeah.
Yeah, no, we can definitely do that. I mean, we have multiple programs. I mean, really the biggest thing is we have a one-time close, two-time close. So it depends on, how you want to finish the loan at the end and how you want to take it from construction to your permanent loan. Your one-time close, it's just that. You start out with your construction loan, and then once completed, of course, there's several things to go in between, but once you're completed, it turns into a permanent. Your 30-year fixed. Two-time close, you close once on your construction loan, and then you refinance at the end of the construction loan process into your permanent. So there's a few different ways, a few different avenues.
So at what point do you come into the process? We have the land, but for those who have not yet secured the land, do you come in and help them purchase it, or what does that look like for you?
So you can do it two different ways. We always start with the loan application first, just to see where you're at. How do we need to do this? How do we map out? How do we get to the end? You can purchase the land up front, or you can purchase the land during the construction process. Either which way, that land is going to get rolled into that construction loan,
Okay.
whether it's before or whether it's during, but the land will end up in there.
So when you're in the initial stages, like we know what we hope to spend. We don't know what we're actually going to spend. So we can pick out fixtures or anything like that. How do you determine based on my application? Is it a range? Is it I can approve you for up to this amount? Whoops, I went over. Like, I mean, like, oh, I accidentally put in that amazing refrigerator. Like, I mean, what does that look like?
So we always look to maximize,
Okay.
obviously keep you in your ratios, but maximize where you can be.
Okay.
Knowing that, hey, this door that I want to buy to put on the front could cost more. This refrigerator all of a sudden became available that I want. So we try and foresee some of that stuff. Now, once you get the plans drawn out, you're going to get a cost to build. Our team always puts a buffer in that cost to build.
Okay.
So if somebody said, hey, I'm going to build an $800,000 home, well, there's usually about a 10 to 15% buffer in there. So we look at it at, $880,000 and take it from there to ensure that if there is a cost overrun or, hey, we changed from this door to that door, this fridge to that fridge, we can cover it and we're in good shape.
Now, what if it exceeds that at the end of the project? It's exceeded that overrun. I mean, the builder's not going to absorb it. Client can't necessarily absorb it. You're not going to absorb it. So what happens then? What does that look like?
If there's a cost overrun, we, typically will see that ahead of the end, and we can regroup. We can look at it, adding financing in to cover that. So basically increasing the loan amount, and that's the biggest thing.
Okay.
And then if there's, money that's not used, well, that gets put back against the loan, and now your loan amount's smaller.
And then are there checkpoints where you guys are evaluating it, or is that on the responsibility of the clients who are building, or is that on the builder's responsibility? Who's monitoring what's being spent and how fast it's going? And obviously it can spiral out of control, and nobody can catch it unless there's certain hurdles that have to be met.
Sure. So there's always got to be checks and balances in place. So at the beginning, when they're setting up the construction loan, the builder's getting pre-approved, because the builder has to be approved as well. You've got to look at certain things with them and make sure that, hey, this guy's not going to run off with the money.
Okay.
Then there are checkpoints, like you said, put in place, and they're draws. So there's draw points, and we set up, say, okay, look, we're going to have 6 inspections. There's going to be 6 draws, so there's going to be 6 inspections. Hey, they've gone through the first draw, they've gotten to this point, they're ready for their next draw. Perfect. We're going to send out an inspector.
Okay.
So the servicer, us, we're going to be the ones to send the inspector out. Yep, there's concrete on the ground. Now there's pipes sticking up. The frame's up. Okay, perfect. We can move on to the next stage.
And that's done before you send the money to the builder.
Yes.
Does any money come from the client to the builder, or is everything absorbed on the front by the lender, and then your down payment is just done at closing?
Actually, great question. I've got a client right now that's building a place in the Possum Kingdom, and there's a specific door that he wants, and it's a 8-week lead time. Well, we're still finishing up the construction loan process, so he's going ahead and paying for that door. When we get to that part of the draw, he will be reimbursed for that door as part of the draw process, because it's already in the cost of build.
And who made that call? Like, how did he know that he needed to do that?
His builder said, hey, if this is the door that you want going on the front of your house, we've got to get it ordered now, because it's going to take 8 weeks to get.
Got it.
So he called me up and said, hey, how can we do this? I talked to our construction team. They said, yeah, no, just he could go ahead and pay for it, and then it just comes out of the draw proceeds back to him.
Got it. So it is possible that client's building will be responsible for some costs up front, and they should plan accordingly for that, I suppose.
If they want to, like I said, I mean, he could have waited until we were done with the construction loan process. That initial draw could have gone to pay for that.
Got it. But when you wait, then you run the risk down the line of the loan closing later and potential for changes in interest rates and all of that, correct?
You could.
Okay. So in your opinion, you mentioned one-time close versus two-time close. Can you talk a little bit more about that? And if one has advantages over the other, or what maybe we should be looking at for our situation?
So the one-time close, it's literally just that. So they kind of take a peek ahead. Obviously, nobody can look in a crystal ball and know what's going to kind of happen, but they can take a peek ahead and say, okay, here's where we have an idea that we're going to be. You know, do you want to buy your rate down when we get to that point on that one-time close? Because that one-time close, you're closing one time. You're going to get your initial rate for your construction loan. You're going to pay that throughout the construction process. When the build is complete, then they turn it into a 30-year fixed and take you to your 30-year fixed rate. A two-time close, I think right now personally is a little bit better. You're not really locked in and you have some room to move when you get to that. You take your construction rate, get to the end of the build process, home's complete, you do a refinance. At that point, if you had equity in your land already, you can actually get some of your closing costs back out of that by doing that refinance. You can also take current rates at that point. If it takes 12 months, well, there's a good possibility you can get a better rate than you can now.
What if it goes the other direction? What if you're planning on that better rate? Didn't happen, can you then revert back to the one-time close, or is it you got to pick up front one or two?
You got to pick one of the two.
Okay.
They have to know how they're going to close it going into it.
Are there costs associated with the second close, like you would have in a normal refinance? Okay.
Yes. Yeah, so normal refinance now, stuff like title work, usually they'll do what's called a reissuance of title, going through the same title company.
Sure.
We usually waive our fees when it comes to construction loans or refinances like that.
Okay.
We waive our fees and then just escrows if you're going to escrow, you know, the normal stuff.
Okay. For us specifically, obviously we have the land already. We know our builder. We know about what we want to spend. What's my next step? Like if you were to kind of give me 1, 2, 3, where am I at? What do I need to do?
All right, so we've got your loan application. Next step is to get the cost to build to us, the plans to us, and builder information. That's step 2 after getting the application to us, because we've got to get the builder approved and we're going to have to reach out to them for specific documents. We don't let the clients handle that. That's us. That way the builder feels good. And then we submit the plans and the cost to build.
So right now you're just trusting that what you've told me I'm approved for is what I've actually been building with my builder so far.
Yes.
Is that right?
That's, yeah, there's a lot of faith in this.
Okay. Because I like nice things.
Yeah. Very nice things.
Nice things, yes.
Yes.
Okay, so what happens if I totally blew it? Then I've got to go back and scale back my drawings?
It may be the selections versus the drawings. Maybe you keep the same square footage. You just buy the wolf, you buy the, Viking.
Okay.
You know.
On my appliances. It is all based on trust, right? Loan application, ideal amount, builder design, selections, hopefully within some range, with some overage expected. And then what?
We take all of that. We submit the builder to a company called Land Gorilla.
Okay.
Land Gorilla, they are the largest construction approval company.
Okay.
They approve the builders. Chances are good if that builder's ever done a custom home build.
Sure.
They've already been approved through Land Gorilla at some time. That process is usually fairly quick as long as we have all their documentation. At the same time, we're approving you guys. We're going to send out the initial loan estimate and say, okay, let's go with your situation. You're already on the land.
Yep.
So we valued the land at this. You've owned that land for more than 6 months.
Mm-hmm.
So we're able to use that equity towards your cash to close. Your position, you probably won't come out of pocket any cash. Our side of the process, we do it like it's a normal loan.
And then at that point, builder gets a green light to go ahead and do what they do first.
So they'll get an initial draw to get started to, prepping land and forms and, dirt work that needs to be done and preparation for the forms and concrete and pipes being laid.
Now, do you recommend a project manager being involved at any point along the way to make sure that all the things that the builder says need to be done are in fact in line with what does need to be done? Or do you just send out the inspector on the back end and that's your check and balance?
We send out an inspector. From a project management, I've seen it both ways. I've seen the clients project manage themselves to make sure the builder's doing what they want.
Sure.
I've seen them hire a specific project manager that they go by that job site every day and they look and they check and they make sure. While the inspector is on our client side, on your side, it's good to have a project manager that is managing your project.
And sometimes that role can be within the builder and his team as well, I would think. So on traditional loans, I know that you've got a lot of options for down payment. Is it the same on construction loans?
Yes. So our construction loan program in the conforming loan limit range, so up to 726,200, we can go as little as 5% down. So it's just like your normal, standard loan of purchasing a home with 5% down.
And you said land value can be used as part of that. So
Correct.
that maybe you're not bringing all the money to the closing.
100%. So let's say, for round number sake, let's say you're doing a $500,000 build. You want to bring 20%. So let's say the land value is $100,000.
Okay.
You don't know anything on it. So you got $100,000 in equity in this land. Well, perfect. Now I don't have to bring that $100,000 to closing for that 20% down that I want.
Okay.
Because that equity is already there. Now, if you owed $50,000 on the land and it was worth $100,000, well, you've got $50,000 that gets put towards that.
Okay. And then I just come up with the additional.
Exactly.
Are there any words of advice that you have for somebody, maybe pitfalls that you've seen or stuff that's come up that nobody expected and you've just kind of learned over the course of your career? Hey, we should watch out for this next time. Anything like that you can think of?
No, fortunately, the construction loan process, it's pretty, rigid for our end. So, we do everything on the front side. Collecting documentation from the clients, from current mortgages and property taxes and W-2s and pay stubs and bank statements to mitigate the majority of surprises.
Okay.
Obviously a couple of years ago when there was still building going on and there were costs that were just skyrocketing.
Right.
There was nothing anybody could do about that.
Right. I guess that's why I asked in the beginning about what happens if it just goes crazy and you don't have control over it. Then what? Do you get to closing and I'm so sorry, you now owe $100,000 more or
Yeah, and that's, like I said, that's where, hopefully the builders, staying in contact with not only you as the client, but me as the lender going, hey, we've got a major cost overrun. Cost overrun by a few $1,000s, that's one thing. A cost overrun by tens of thousands of dollars, somebody should have seen that coming. So hopefully somebody saw that coming. It's not a surprise and we're able to work through it at the beginning versus, it's the last day I need an extra $10,000, But that's also why there's that cushion in there for that, 10 to 15%.
And then at the end of the process, when everything's, final completion, still the normal appraisal, loan value that you would see in any other situation?
Yeah, we'll send, and I'm glad you said that. We actually send an appraiser out there at the beginning. Appraiser's going to go out, they're going to evaluate the land because, you own your own land already.
Sure.
So they're going to appraise the land, then they're going to look at the plans because the appraiser has the plans, and they put that together and go, okay, so with the land and the build, and there's a similar house over here like it, and there's another similar house over here like it, another one over here, this house should appraise for X amount of dollars. That's one of the cool things about the two-time close is you're able to utilize the appraised value at the end to dictate your loan to value on your mortgage.
Versus the estimated one on the front.
Exactly.
What if the appraisal comes in short? Market's great right now. What if the market's not great when this house is completed? Maybe the area is overdeveloped, maybe, I don't know, maybe the economy has changed. What if my appraisal falls short of what I need the loan to be and there is no more buffer and I don't have the money to pay the difference? What happens? I mean, that's like the worst possible case scenario that I can think of, right? The house is built on land that I own, and yet I can't pay for what I just built because the appraiser says that it's not worth it.
I would have to get the true answer from somebody else because I've never been in that situation.
Okay.
I would expect
Let's
Yeah, let's not.
Let's not go there.
Yeah. I would expect that the builder would be putting a lien on the house until funds were available.
Okay. So I could still, in theory, take ownership. You would loan the amount that I was approved for, and then the lien, likely, we're assuming here, would exist until I could pay the difference down.
Or we could explore, possibly, getting a second lien to cover some of that. I mean, there's ways to go.
Ask the hard questions.
That is a hard question because, thanks.
I don't want to be in that situation, but I also want to just kind of acknowledge the reality that the market's great right now, but it may not always be great. And that's a risk that you take when you take on a project of this size.
I'll tell you, so fortunately though, depending on where that loan to value is, and that's another thing that comes into play. They're going to look at it and they're going to go, okay, well, we're above the conforming loan limit, we're going to probably want more down. So that at least puts you in a position where at the beginning they're going off of here's what the land is, here's what it's going to cost, here's what it's going to be worth. If it was today, you're still using just the cost for the loan versus the value.
Okay.
They want to make sure that, hey, the value is at least going to reach what the cost is.
And in theory, you're not approving me at my maximum in the beginning.
I'm not approving you at 100% loan to value.
Right.
We're approving you at, like I said, of course, anything over 726, it moves into a jumbo. Well, there's different down payments that go into that. That's typically a 20% down at that point.
Okay. So I guess what I'm hearing you say is there's a lot of options that you would deploy before we would ever get into the situation that I just asked about.
Yes.
Okay.
So I think I kind of did this a little out of order. Obviously, I already own the land. We've already done the design process with the builder.
Mm-hmm.
At what point do you normally step in? Like, would you want to get in before the land is even purchased? Or are you trying to get in prior to when the drawings are done so that you can then roll that into the cost? When do you step up?
I would like to be involved at the very beginning because clients don't know what they're approved for. So you go out and you spend $10,000 on a set of plans for a house that you can't afford. And now you're like, oh, well, that'd been great. And so now you're kind of out that money. So, really starting at the very beginning before you even start that process is where you really need to start, just so that you know how much you're approved for.
So it's kind of like a traditional purchase where I tell people that I want them to talk to you before they even start looking online. Because once they've looked at a home that's out of their budget, nothing else will ever measure up.
Exactly.
In the design process.
That's exactly what it is. Okay. You start building this house and then you're like, ooh, I want this refrigerator and I want my kitchen to be like this. I'm a kitchen guy. I love the kitchen. I love to cook. So I want a 6-burner, or 8-burner gas stove. That might not be in my budget. My kitchen, I might not be able to make my kitchen big enough for what I want. I might not be able to make my outdoor patio big enough for what I want. So need to know how much I'm approved for so that I can say, hey, here's what I'm approved for. Here's what I'd really like. Here are my wants. Here are my needs. So I guess that's kind of how you start your process. What are your wants? What are your needs? What are your must-haves?
Yeah. So one of the things I looked at earlier as we were talking is this poster over here. I'm coming for everything they said I could. That's awesome. I love it. Because I don't know what it was like for you starting the business, but for me, I was told you started too late. There's too many agents. You'll never be successful. You got in at the wrong time. All the things that you don't want to hear when you're starting up your own company. That right there, it's like, watch me.
Yeah, and that's what that's for, because we've got several young loan officers, and it's tough to get into this business. It's really tough, whether it's real estate side or whether it's the lending side. It's tough to get into this business. And so that's one of those things, because yes, I was the same way when I got in. I was like, watch out, here I come. I've been fortunate to make it up to a sales manager position. And that was just from grinding and hard work and attaining the unattainable.
Yeah, it's worth it.
So if you made it this far, thanks for watching. And I'm just going to hang out here and perfect my golf swing all day because this is way more fun. Thanks so much for watching. Please like and subscribe. It really does make a difference. We'll see you in the next video. Ah! I got it.